Thank you, Amy, and good day, everybody, and welcome back to Eide Bailey's series of monthly webinars on GAAP for state and local governments, as well as compliance. And I'm with you, Amy. My allergies are killing me as well. So today's session is on our favorite topic, it seems forever, GASB 87 for leases. These days, there's not 1 hour, it seems, when I do not receive an email, a phone call, or a Teams invite on something having to do with leasing. But I keep saying to myself, we're really headed close to the finish line here on GASB 87. After all, it's the NBA Eastern Conference Finals. My Celtics didn't do so well last night. That third quarter killed me. The Kentucky Derby has been run. The Preakness is coming this Saturday up the road from where I am today in Washington, D.C. It's supposed to be in the 90s on Saturday for the horse race. So it's going to be a hot one out there. So we are indeed at showtime for implementation of GASB 87. As Elvis sang too many years ago, it's definitely now or never. So my name is Eric Berman. I'm a partner with Eide Bailey out of the Boise office. And you've seen me in webinars before, of course. Joining me today are two other partners. Brian Stavanger, he's out of our Fargo office, and Brian's been with Eide Bailey for over 21 years. He's devoted much of his career with Eide Bailey serving the accounting needs of public sector clients, including local governmental entities, public schools, charter schools, as well as colleges, universities, and utility cooperatives. Now, to support Eide Bailey's commitment to staff development, Brian offers continuing education opportunities. He serves as an instructor for firm-wide governmental trainings, including webinars like we're doing today. Also joining me is James Ramsey from our Northern California offices. Now, James works with governments throughout California, providing accounting, assurance, and advisory services. And he's worked on both the client side and the assurance side, just like me, and he's able to provide this unique perspective to his clients. Now, before going into public accounting, James began his career in the finance department of a small city, and he performed most, if not all, of the functions of a finance department during his 7 years there. So he feels your pain, small city governments out there. This unique background and expertise allowed James to provide more focused advisory services and solutions to all of our clients. And it's great to have you here, gentlemen, with me. So to get things rolling, we're going to give you one last in-depth look at GASB 87 for lessees. As many of you are June 30 governments, the time is now. But also we have some breaking news for you. We have a brand new GASB standard out there, GASB Statement number 99. And GASB 99 may impact some of the decisions you make in implementing GASB 87, especially in recognition of a short-term lease. In many respects, a loophole that is within these short-term provisions is about to be closed by GASB 99. Now, before you head to the exits, the provisions we'll be talking about will be implemented for periods beginning after June 15th of this year. So July 1st for you June 30s. We're not talking about the previous July 1st. We're talking about the next July 1st for you June 30s. But before you breathe a sigh of relief, the changes may require a further beginning balance adjustment. So it's prudent for us to look at them really carefully today. After June 15th of this year, we're also going to have GASB 94 and GASB 96 to consider. Again, GASB 99 has some alignment factors within it for both 94 and 96, in addition to the changes that are going to be made in GASB 87. Now, we're also going to talk about the audit issues likely coming related to GASB 87. And then if you haven't started yet, some of the implementation strategies that we're seeing. Now, just in case you're a new government or you're new to government, and I have both, or you need a refresher course in GASB 87, you know, we've been talking about GASB 87 in webinars since November of 2019, or as I like to say, that's probably about 2 months BC, or, you know, 2 months before we had COVID. But we really began when the standard was being deliberated and researched by the GASB. I have webinar decks saved mentioning the GASB leasing project as early as April 2013. That means I've been talking about leases for over 9 years. And April 2013 was right before I joined Eide Bailey and merged in. So I've been talking about leasing for a heck of a long time. And as much as I have talked about it, I still see the stuff that makes me think, you know, I really need to dig into the weeds and think about this one more time. I had one overnight that mentioned a rate factor, and this is from one of our clients in the far west. And they said, gee, I got this lease document that mentions this phrase rate factor. What is a rate factor? And boy, it's not even mentioned in GASB 87. And it turns out it's much like the money factor when you go to lease a car. And you have to do some real gyration, and you know, based on Wall Street jargon to come up with what that answer is. And even then, you still have to do some back-end present value calculations to come up with what the true interest rate is on that particular contract. So I see new things, it seems, every day. The most recent webinars available to you start in 2019. Now, these are all for free and all on YouTube. Of course, no CPE for them, but if you are somewhere with nothing to do for 10 hours, you're sitting on the beach with Snoop Dogg, and instead of drinking Coronas, you want to watch, you know, GASB 87 webinars, God bless. You know, there might be, you know, more to know about GASB 87, and why not have at it? Just search for GASB 87 on YouTube, and there you are. Okay, so let's start off with the overview of GASB 87 for lessees. Again, we have to, you know, we have to tell you 10 times for the normal mind, 100 times under stress, as my former coworker used to say to me. Just in case you were looking for that get out of jail free card in the form of another extension or a repeal of GASB 87 contained in GASB 99. No, the board did not grant your wish, although some folks, in responding to GASB 90, what became GASB 99, did ask for another one. No, you didn't get your wish. Again, it's showtime. We just have to get our fingers dirty, grin and bear it. GASB 87 is for real, and we got to do some work. So again, GASB 87 is part of a global change in the lease accounting and financial reporting framework. Both sides of the table are changing, where your government is a lessee, which is so far, since we've been working with governments since late in 2019 to implement GASB 87, that's by far the most common, but also where your government may be a lessor, which we're going to be talking about next month. Again, this is a global change. International, for-profit, not for profit, the federal government even, all entities are adopting very similar models in leasing. Tribal nations, airports, ports, marinas, utilities, casinos, and entertainment venues that are governments or non-governments even, all are implementing this year. Now, there are certain aspects of the new standards that are easier than other aspects, but by and large, the lease standards released that impact your government have been around for well over 40 years, and in some cases, close to 80 years. These are so entrenched, and they really needed to be updated for current practice. Now, due to this lack of change, leases have been using pretzel logic to fit into various exceptions. And this raises an enormous problem. There are many, many operating leases out there that are really non-cancelable. And you may want to think about what you're facing. Now, look at your current ACFR's operating lease disclosure. And if you have operating leases in your note disclosure, say going to the year 2065, by my calendar, that's 43 years from now. And there's no way that a lease going to 2065 is a short-term lease. Another challenge is, again, this financial engineering built into many contracts. In many cases, governments are limited from issuing any form of debt, and a lease is a debt of the lessee. After all, as a lessor or as a lessee, you sign a contract, and in the case of a lessee, you have to fulfill the terms of the contract and live under the constraints. One of those terms is that debt needs to be paid somehow, some way. And that's part of what we are all dealing with as we all implement together. Because guess what? The auditors have to understand this stuff too. Over the past 2 years plus of working with our clients to implement, again, I thought I'd seen it all, but every day I got something new. And some of that has to do with this engineering that has been done. Now, you've had an extra year to implement, as did other entities, but that time is over. We really got to move forward, as there are other standards that we will talk about a little bit later during our webinar that follow the framework. And due to those other standards in the model within GASB 87, this is one of those standards that is not implement and you are done, or one of those situations where you only implement it when you need to. Now, coming up later on this year, when we talk about the forthcoming Statement 100, which is on accounting changes and error corrections, that's you implement it only when you need to. You know, this is one where you're going to have to keep implementing forever on this one. Depending on your government, GASB 87 could be as pervasive as pensions or OPEB standards, but not nearly as major of a change as GASB 34 was, oh gosh, now almost 20 years ago. So if you haven't started, now is the time. And there were a few of you in that polling question that did not start it as of yet. So now is really the time. So again, you know, just in case you've missed it before, under GASB 87, what is a lease? A lease is a contract that conveys control of the right to use a non-financial asset, also known as the underlying asset, for a period of time as specified in the contract in an exchange or an exchange-like transaction. And again, each one of these words is really, really precious. You got to understand them, you know, and there may be many types of agreements in your government which may be in scope or may not be in scope under GASB 87. It depends on alignment to this language. Now, notice I said the word contract. That is vital. And the reason is many leases do not have the word lease in them. They don't have the word rent in them. Now, there is a paragraph in GASB 87 that states that leases include contracts that are not explicitly identified as leases, but meet the definition of a lease. Now, this means we are indeed looking for needles in potentially a very large haystack. So let's try to understand these phrases further. What is a non-financial asset? It's almost as if, gee, you'd know it when you see it. But guess what, folks? Non-financial assets aren't defined currently in GAAP, but that may be changing. We may see an exposure draft on that one during the middle of 2023. If whatever proposed language from the GASB sails through, maybe we see a final standard by March of 2024, but we're years away from any conclusive GAAP. But let's use some logic here. If a non-financial asset is not cash and investments, then it's got to be a non-financial. It's got to be easy. It's everything else. Everything else is a non-financial asset. The gray area kind of falls on receivables and prepaid assets. Now, again, some of those, especially prepaid assets, those are the mongrel dogs of the asset side of the statement and net position. Are they financial or non-financial? That's the big question. But we presume that capital assets are non-financial. But then we got these things right to use assets, which is the debit side for lessees of GASB 87, 94, and 96. So not as easy as you think it is. Exchange and exchange-like transactions, we've known about these for a while. So let's use an example. For example, let's say your government is leasing land for $1 a year when the value of that land is $100,000 per year. Okay, that's not exchange or exchange-like because the market rent is much higher than what it is under the lease. Now, similar agreements in your government then may not be in scope for implementation under GASB 87. Now, the most common examples of exchange and exchange-like transactions are primarily things like licenses, permits, developer charges, grants, and donations. But when you got a situation that's $1 per year and the market value of the land is $100,000 a year, chances are that's something like an easement or something like that. Under the conceptual framework of GAAP, assets are resources with present service capacity that the government presently controls. Now, that is easy to understand until you get to leases because of things like build-outs. Again, it's a game of Jenga in a lot of ways. Again, we see tons of questions every day. And I mentioned the $1 per year where the fair value is $100,000 per year. That's going to be out of scope because it's not an exchange transaction. But what about a multi-year agreement for the right to use a building? And the government has exclusive use of the building, but only for a few days a week. Other parties can use that building on other days. And if the contract stipulates only 3 days a week and the government is following that 3-day-a-week contract, then guess what, folks? GASB 87 applies, assuming it's an exchange or an exchange-like transaction. I mentioned the word easements, and that's very common, especially involving land. Now, some easements meet the definition of a lease, others do not. There's got to be a period of time in an exchange or an exchange-like transaction. Now, permanent easements, which last indefinitely without a cancellation option, they don't meet this period of time criterion. In addition, easements obtained for an amount that does not meet the description of an exchange or an exchange-like transaction, again, say $1 every 5 years, that's also not an exchange transaction. So we got to be careful on easements. Solar farms are really tricky. So let's say a government enters into a contract with a business where the business will design and build a solar farm based on the government specs. Now, the solar farm will be located on the government's land, but the title to the equipment is going to be retained by the solar company. Who will, and the solar company is going to determine the manner of use. Now, the contract requires the government to purchase all the power generated from the farm and make payments based on the amount of power generated. Now, the contract also requires the business to dismantle and remove the solar farm at the end of the contract, let's say 40 years from now. Now, this contract is not meeting the definition of a lease. Remember, GASB 87 provides 2 criteria that should be present to convey control. In this example, the government has the right to obtain power from the solar farm, but doesn't have the right to determine the manner or use. Therefore, the component of the contract that provides the government with the right to all the power generated by the farm doesn't convey control, and it doesn't meet the definition of lease. This is just an easy peasy power contract. However, the component of the contract that allows the private party to use the government's property, now that may be a lease. It may be a land lease. So there may be 2 separate transactions going on here, and we got to do some more digging. Cell phone towers, almost the same. Again, we're focusing on, does the entity have control? The control criterion generally is met if a cell phone tower or an antenna placement agreement conveys control of the right to use the land on which the tower is placed, or the connection point to which the antenna is affixed, such as sitting on a government building. Okay, now armed with all that jargon and knowledge, how do we get organized and go implement GASB 87? First, where do we start? Now, governments routinely sign, again, contracts that may or may not align to the definition of lease. And we got to be aware of other contracts that may use the word lease, but are not really leases. Now, back in my former life, when I was in public service like James, I signed hundreds of these contracts in the 1990s, and they were really debt agreements with municipalities to skirt the municipal debt limits in my state government. And we use these agreements called tax-exempt lease purchase agreements, or TELPs. Now, what are these? They're really borrowings. Okay, we got to gather a pile of contracts. And for some of you, that could be a lot of work. Okay, once you have the stack of contracts, again, some of you, they may be paper, others, they're going to be electronic. Then you need to make some notes. Which party is your government? Are you the payee, meaning the lessee, or the receiver, meaning the lessor? Now, in some cases, you may be both, and that's a sublet situation. Now, make note of any special provisions. The most common of these is going to be purchase or sale provisions, such as the ability to buy copiers or the truck at the end of the lease for $1, or the ability to sell land to the lessee for $1 at the end of 40 years. Remember, there may be provisions where your government does not have control of the property being leased, and you may have to share it with other entities, and that means that's non-exclusive use. Now, make note of that in all your documentation. Now, remember also the $1 per year for 5 years and all that stuff. That may not be a lease as well. Now, there are tons of flavors of special provisions that may be in the mind of the lessor or the lessee, all of which should be documented, as the provision may change the asset or the liability. Now, I look at GASB 87's implementation in piles or buckets to determine what is in scope or out of scope. So we have our pile of contracts. Maybe we start a spreadsheet or a database of them all. That's really a great start. So let's set up a pile of the contracts that are out of scope per GASB 87, but we got to be careful because other GAAP is out there. Our first pile is going to be contracts that result in intangible assets such as software. Now let's hold those aside, as some may be in scope starting this upcoming July 1st for you June 30s out there due to GASB 96. I was in a board meeting yesterday at an entrance conference for one of my clients, and the accounting manager made a presentation on GASB 96 and the impact on this particular entity. They have maybe 6 total leasing contracts. They have well over 100 software contracts that may be in scope of GASB 96. So GASB 96, as we'll talk about a little bit later today, that may be more pervasive. Our next pile is going to be service concession arrangements for golf courses, higher education bookstores, cafeterias, dormitories. Again, hold those aside again, as some may be in scope starting this upcoming July 1st for you June 30s out there due to GASB 94. Now, our next pile, that's going to be borrowings related to conduit debt issuance. Now, you know who you are if you issue conduit debt or you are party to a debt. Those issuers include housing finance entities, water sewer infrastructure funds, and so on. Some of those issuances may be conduit debt. Let's hold those aside for now, as we're going to have GASB 91 coming up, which we'll talk about probably later on this year. Our next pile will be borrowings related to, again, that debt that really result in a debt issuance. And again, you know who you are on this one. The tax exempt lease purchase, it transfers ownership. Again, those are really financings or borrowings. You know, if they don't have a termination option, you're going to end up with that asset. Now, again, we need to consider those now, and they need special work. There's also a pile for special provisions, for lessees, such as those at airports or ports, defined benefit plans where the underlying asset is an investment. We're going to hold those aside as well. Okay, I have 5 piles. Now, again, what can I toss back into my file cabinets? Again, the stuff that's excluded include biological assets, inventory contracts, power supply contracts I mentioned with solar, contracts where there's non-exclusive use of the underlying asset. You can take those pieces of paper, throw them back into the file cabinets, but don't lose track of them because they may be sampled as to why they weren't leases. Pile 6 is everything else in GASB 87. Okay. So what are my 6 piles? Again, intangible assets such as software, service concession arrangements and public-private partnerships, conduit debt arrangements, tax exempt lease purchases and other purchase agreements, contracts involving assets that are investments or regulated assets. And then we got everything else in GASB 87 that would be in scope. Okay, now that we figured out what is in scope versus out of scope, let's get our hands dirty and calculate the lease term. For a contract to be short term at the end of the day, it's got to be at the day of contract signing. And again, it's at contract signing. A maximum possible term of 12 months or less, including any options to extend, regardless of their probability of being exercised. Now, for a lease that is cancelable either by your government as a lessee or the lessor, such as a rolling month-to-month lease or a year-to-year lease, the maximum possible term is the non-cancelable period, including any notice periods. But be careful, your government undoubtedly has a fiscal funding clause in its contract. Nearly every contract I've looked at has a fiscal funding clause. They're great for budgetary and compliance purposes, but for GAAP, they do not signify an operating lease anymore. Don't go down the road of the examples on the screen. None of those would be short term. I know you want to do the lease on the office space for 12 months with 49 annual renewals, or the other 2, but no, those are not short term. Be careful. Changes are indeed coming. We'll talk about these in a few minutes. How the heck do we determine the lease term? I say this often, I keep this on my desktop. It's right over here. Dog ear it, bookmark it, do whatever you need to do. Just keep it in your mind's eye. In each contract, you got to identify the non-cancelable period. And again, that's the period where neither party can cancel the contract. And then we need to ask ourselves about 4 potential options. Does the lessee have an option to extend the lease? And if the answer is yeah, then yeah, that period to the non-cancelable period, if it's reasonably certain that the lessee will extend. Now, do you have an option to terminate the lease? But it is reasonably certain that you're not going to extend. Does your government as a lessee then have an option to extend the lease, and it's reasonably certain that there's something going to be required? Does your government as a lessee have an option to terminate the lease, but it's reasonably certain? Again, you got to understand what that all means and sum all those periods up, and that is your lease term, as it says here on the screen. But again, hold those thoughts. Now, again, we're going to bring out the caution tape. GASB 99 was approved by the board about two and a half weeks ago. There are 2 major changes on what we discussed so far. So first, let's talk about options. Again, an option is an unconditional right that exists within your contract. A provision that gives a lessee or a lessor the right to terminate the lease only only in certain circumstances or upon occurrence of certain events, such as an action that has to occur or an inaction that occurs, of the other party in the contract. That's not an option to terminate for purposes of determining the lease term. So, for example, provisions that allow for the termination of a lease due to a violation of lease terms and conditions, such as a default, they're not considered options to terminate the lease. Now, this also applies to purchase options. If a lessee has the option to purchase the underlying asset during the lease term, and the contract is not a contract that transfers ownership, the lease term would exclude the period after the date at which the option is reasonably certain to be exercised. And we're going to talk about transfer of ownership contracts in a jiffy. But the biggest deal so far is going to be a closure of the loophole that may have allowed short-term leases. GASB clarifies the situation where periods for which both the lessee and the lessor have an option to terminate the lease without permission from the other party, or if parties have to agree to extend, those are cancelable periods, and they should be excluded from the maximum possible term. But here's the kicker. A lease that previously had been determined by you as a government to be short-term, and that has now been modified to extend, the initial maximum possible term under the lease contract will need to be reassessed from the inception of the lease. If the reassessed maximum possible term is more than that 12-month period, then the lease is no longer considered a short-term lease. For a lease that's reclassified from a short-term lease, the lease then would be assessed from the beginning at the date of the modification for purposes of measuring that liability. So let's say you modify you had a short-term lease, and let's say on May 8th, the lease was supposed to end on June 30th, and on May 18th, you decide to modify the lease using the existing terms and conditions of the liability of the lease contract, then the measurement starts at May 18th because you initially figured out it was a short-term lease. So let's say you extend until the next June 30th, June 30, 23, then guess what, folks? You don't have a short-term lease because today's May 18th. So it's longer than 12 months. Again, you have to have a modification of those original terms. The reassessment, again, would be from the date of modification. But for this year, you might as well measure from the date of implementation. And that provision, again, is effective for periods beginning after June 15 of this year. But if this is your implementation period, you might as well early implement. And again, we're gonna wrap up GASB 99 later on in the webinar. Okay, so now that I got that off my chest, how do we calculate a lease term on a real lease? And this is a real lease agreement that you probably have. This is from Canon Copiers for a group of multifunction printer copiers, and this is common. 60 monthly payments for $3,225 per month. We got 10 machines plus a scanner and conversion modules. Now, the conversion modules are required as the multifunction printer copiers, they don't work unless you got those conversion modules. So here are some of the elements of the lease here. Again, we're paying Canon Financial Services. The term begins on delivery. Now that's important because that conveys control on delivery, especially these days with supply chain issues. That delivery date is really important. And again, until your government has control of the property, plant, or equipment, you got no lease term, you got no lease. You might have a contingency, but you don't have, or a commitment, but you don't have any lease. Now back to our equipment. That is only a matter of a few days, but in office space, that adjustment may be a few months. Now, GASB, again, explains that the lease term commences when the lease has the right to use the underlying asset without condition. It further explains that you have the right to obtain present service capacity and the right to determine the manner and the use. And therefore, the lease term doesn't begin until they got delivery of the copiers. You got a fiscal funding clause there, and for budgetary purposes, again, your government may say until the city council appropriates, there's a slim chance of canceling the lease. Now, again, you got that reasonable certainty clause you got to deal with, but you know where we're headed. Now, where does this all lead? Back to our equation, you got a non-cancelable period, you got a certificate signed that there's a delivery, just like any other equipment delivery order, you got a fiscal funding clause, and you got a purchase option at the end of the lease, but something we're going to beat the snot out of our copiers, and guess what? We're going to turn them back in. Okay, so let's put these numbers into text. Here we go. Okay. Using our equation, I got 60 non-cancelable months. We're not going to extend because we're going to beat the snot out of the copiers. We can't terminate without a serious penalty. Can and cannot extend, and can only terminate for breach of contract, but something, we pay our bills. So we're at a 60-month term. Now, notice I'm saying 60 months and not 5 years. 60 months, for those of us who understand the effective interest method, it's quite different from 5 years. And we're going to need to use the effective interest method, just like your mortgage, in calculating and amortizing. Okay, so let's go a little bit deeper on those contracts that transfer ownership. So if the underlying asset is purchased by your government, that is a lessee, we got to take a different approach. Again, these things are usually called tax-exempt lease purchase agreements or something similar. There's usually language within the agreement that contains some transfer of title, say for $1. Now there should not be a termination option in there, but there may be some form of fiscal funding. Again, we got to have some form of bona fide transfer, meaning you got to have a sale, and there must be a purchase, of course. If this is the case, the entry for your governments, that's easy. Just reclass the lease obligation to a note payable, as it will not be a lease. That said, you might have a different discount rate, and we'll talk about discount rates shortly, but your debit would be to the existing lease obligation, and your credit is going to be to the new note payable. Any adjustment due to the discount rate change, that's going to be the beginning balance adjustment. You would also record a debit to a capital asset at whatever the carrying value you have on your asset is, meaning the net of accumulated depreciation. Because, hey, you might be in the middle of this thing, and so you might have already depreciated a bunch of it. There may be an additional adjustment to your beginning balance due to the recording of that asset side.
Yeah, once you figured out that time element and whether the contract is in scope, then we get into the fun part of it, doing some math to figure out the numbers, which hopefully the vast majority of us here enjoy that part of it, the numbers. So where do we begin? And unfortunately, we can't jump right into the numbers. I'm excited to get into the numbers, but first let's just understand the concepts behind it. So GASB 87 requires at the inception of the lease that an intangible asset be recognized for the right to use that underlying leased property. But of course, it's GASB, and it might not be that simple. And in some cases, the value of that asset might not be the same value as the liability at lease signing. So we've got to adjust that liability for any prepayments, any incentives in order to arrive at that lease asset. So once you get to that lease asset, at least you've got the debit side, which is very important. And so next, it's what's the credit? What's the credit side to that entry? And remember, we haven't calculated any numbers yet. We're still just really talking theory here, and we'll get into the numbers using what Eric started out with, that Canon copier agreement. The credit side would be, of course, the lease liability, and that would include fixed payments, which are most common. So hopefully what you're finding out, or what you are going to find out as you're going through all of your potential contracts and determining if they're leases or not, hopefully that's a fixed payment. There's also the potential for two variable type payments. The first one dependent upon an index or a rate such as CPI. The second variable payment that could be out there is where it has minimums or maximums, what's also known as fixed in substance. So what this doesn't include would be any payments that are dependent on usage or performance, things such as miles driven, hours used, copies made. So that is not a consideration at this point. That will come into play a little bit later. So then when you calculate the liability, I'm going to make it sound easy. It's really just like calculating your mortgage, your home mortgage. And then amortizing that liability is just like your home mortgage. Sounds easy, right? And I'm probably portraying that to you. Sounds easy calculation. Here's the considerations, but it's GASB, and it's just simply not always that simple. So the lease can be amortized in any systematic and rational way if the period is the shorter of the lease term or the useful life. Something that maybe you haven't seen before, maybe some of you have, but the grouping method. Grouped methods can be used. So a great example would be those 10 Canon copiers that Eric spoke about earlier. Those can be amortized as one group of copiers, even if they can be substituted. It does allow you to group those and then amortized as one group. It's really up to you. It's up to the government as to which method you want to use. We would suggest the effective interest method. It's usually best if there's a chance that the lease can be modified or terminated. Whatever you end up choosing, just making sure that that's disclosed in the notes. You're going to hear a lot of that from me during my section of this presentation. Make sure it's disclosed. Make sure it's in policy. You'll hear that quite frequently. Can it be straight line? Sure. Straight line is easy to understand, easy to calculate and implement. Certainly can be straight line. Really, the kicker here is if the lease is modified in any way later on in that lease term, you're going to have a gain or a loss. So an example, keeping the Canon copiers as our example is, what if during that lease term that technology becomes obsolete? And all of a sudden you need a new copier. You're still within that lease term. You need a new copier because the technology just doesn't allow you to use it how it should be used or how you want it to be used. But Canon doesn't allow you to modify that existing lease. If that's the case, then you might have a gain or a loss to account for when it comes to that lease. So really to help with that, you might want to amortize the asset the same way as the liability using that effective interest method. Repeating myself here, and I warned you on this, whatever you choose, just make sure it's disclosed as part of your summary of significant accounting policies. It can be a simple one-sentence disclosure. That is perfectly fine. Just make sure that is in there. So here's something that is probably the most common question that we have, or when we're discussing GASB 87 capital leases, when we're discussing them with clients or others. What's the discount rate? And really, wow, has that changed a lot in the last year? So as we've had these discussions and we've reviewed contracts with some of our clients, really in the last 3 years, if we accumulate all those, we've probably looked at thousands of contracts. And in those reviews of those contracts, guess what? One time out of all of those thousand, one time the discount rate was stated explicitly in that contract. So if you have been struggling to find a discount rate, you've been asking around, you've been working with others in your government to say, where's the discount rate in this agreement? Extremely common that it's not going to be there, which can get frustrating at times. So again, one time in the thousands of contracts that we've reviewed, it's actually been there. Now, a word of caution, a word of warning that, for example, vehicle leases. You'll see what's in vehicle leases commonly called a money factor. That's really just a vehicle leasing industry jargon. That's not the actual discount rate. That's just a jargon that they use in that contract. That does not relate back to GASB 87 and discount rate. You still need to calculate that real discount rate. So then we all know there's really 3 things that are needed to do a present value calculation of that lease liability. We need to know, 1, the interest. I combined 1 and 2. 1, the principal. 2, the interest. 3, the time. Those 3 items, principal, interest, and time, are needed in order to do that present value calculation. GASB requires the incremental borrowing rate. You have to use that incremental borrowing rate, which is likely the estimated interest rate that will be charged for borrowing the lease payments during the lease term. So in most governments that we've dealt with, that's not easily done because there's really not a comparable that they can find. They're usually not in the market at the exact same time to issue similar debt for similar term in the similar time frame. So you don't really have, well, we've got this lease transaction, and thankfully we've got a very similar debt transaction that we can then just use those assumptions and apply those to the leases. That's great if that situation exists, but in reality, it doesn't exist most often. So in these cases, then there needs to be a policy. So there's that policy keyword that I warned you about. There needs to be a policy for these cases for lessees to determine that discount rate and then implement that policy. So have a policy in place. How do you determine that discount rate? Then you can implement that policy, apply that discount rate, and move on. Could your government use the risk-free rate of US Treasuries, for example? Yes. That policy needs to be documented, effectively used, and then the period chosen aligning with your lease term. So it really all goes back to, if you spend some time planning for this implementation, understanding your policy, getting that policy in writing, and then making sure you're following that policy in practice. That's what we like to see: consistency and policy in writing. So really, once you've determined that interest rate, use the effective interest method to amortize, just like a mortgage. Payments are first allocated to interest. So whatever you choose, if you haven't heard me say it 6 times already, just make sure you document that policy. You're hearing this from the mouth of an auditor. Eide Bailey, as an audit firm, and any other audit firm across the country, they're going to want to see that policy documented, approved, documented, and then followed. If you're sitting there and you're thinking, this is a big lift for me as an individual at my government, please don't think of it that way. Think about it as a team effort. Hopefully you've got someone else within your government to reach out to, possibly your treasurer, your CFO. Utilize your audit firms. If we're your audit firm at Eide Bailey, utilize us as a resource to help you understand how to get to that policy. Remember that rate must align to at least the non-cancelable lease term. Okay, what flows determine that lease liability or asset? This is a great cheat sheet right from the AICPA State and Local Audit Guide, Appendix D. You can see that on the bottom left of this screen. A good little cheat sheet to help you determine that lease liability. Really want to point out on this slide the 2 items in red, the red indicators there. We'll talk about variable payments later on in just a few minutes. So really want to focus on that contingency. So I talked about that contingency potential a few slides ago. So notice that if there are contingent payments that are based on that usage or performance, so something contingent, and it's that underlying asset, things such as miles, copies made, things that we've talked about already, do not include those values as part of the liability calculation. Do not include those liabilities. We're going to, as you present value that liability, make sure those are not included in that calculation. There's a lot going on all of these slides. There's a lot of great information. Thankfully, Amy has provided a link within the chat to where you can access those slides. Hopefully a resource that you can continue to use, not only today as we're going through, but as you walk away from this webinar and really continue to dive into your GASB 87 opportunities. So what about remeasuring a lease? When must a lease be remeasured? It does occur. You've likely been a part of a lease that's had some sort of modification in the past. Very, very important when we enter into this world of GASB 87 being effective, that you understand when remeasurement may be required. So really, if one or more of these changes occur during the reporting year, when you compare it then to the prior year, so the change happens in the year of reporting, and then you compare that, because it's been a change to a previous year. And the changes have to be individually or in aggregate an expectation that they significantly affect the amount of the lease liability. So we'll talk more about that, but really one or more of these have to occur. So let's go through them first. Item A, is there a change in the lease term? I would say that's a pretty straightforward one. The second one, the likelihood of a residual value guarantee being paid. Has that changed? So an example would be, are you forced to buy the copiers at a guaranteed value at the end of the lease? Did that change? Did that opportunity change it from reasonably certain to not reasonably certain, or potentially vice versa? If that happened, then you're going to want to continue the assessment to potentially remeasure. The third item, did your government change your mind on exercising a purchase option, meaning the likelihood of exercising that purchase option changed from reasonably certain to not reasonably certain, or vice versa? So really a change in your mind on exercising that option. Either way, potentially could trigger this remeasurement. Was there a change in the estimated amounts for payments already included in the measurement of that lease liability? Excluding any change in the index or change in the rate, and we'll talk about that in a minute. Was there a change in the interest rate the lessor charges the lessee if used in the initial discount rate? Also, was a contingency upon which some or all of the variable payments that we made over the remainder of the lease term are based, was that contingency resolved during the year compared to the prior year? Was that contingency resolved such now that the payments meet the criteria for measuring the lease liability? So an example of that would be something that causes variable payments that were contingent on a performance or use of that underlying asset to now become fixed. So it went from variable payments to fixed because of some triggering event or some contingent event that then happened. So in other words, has your government hit that maximum or minimum payment? So remember, these things would have to happen. One of these would have to happen. And then we would have to consider the significance of that. And we'll get into that in a little bit. Another reminder of the breaking news of GASB 99. And I tell you what, when I saw a couple weeks ago that GASB 99 was approved, I thought, and I know there's several of you probably on this call right now or on this webinar that were around for implementation of GASB 34. And that sometimes that feels like a long time ago. Sometimes that feels like it was just yesterday. But to think that now we're just one away from triple digits, GASB 100, it's just unimaginable. Aren't we having fun with this? But GASB 99 does adjust these provisions slightly. So if variable payments are fixed in substance, meaning there's already a ceiling or a floor, they're included in the liability. All other payments would be just outflows. So governments will not have to remeasure the liability just for a change in the index or rate, which is nice, a bit of a relief from GASB. Not sure we say that very frequently, that GASB provided us a little bit of a relief. So this is one thing we want to shout out to GASB for providing that. Extremely important, especially in the times we're in now with inflation. So as index or rates change, you don't have to remeasure the liability. You could, but you don't have to. Really, something else has to go on, meaning not only the rate, but perhaps the lease term changes. So there's got to be multiple changes. It's not just triggered by a change in the index or the rate. So as Eric mentioned previously, GASB 99 really not in effect until periods beginning after June 15th. So really thinking to June 30, 2023, but very possible, and we're guessing a lot of you are going to early implement this right alongside your implementation of 87, but you do have the ability to delay it until its actual implementation date of really fiscal year 2023 for your June 30 year ends. Okay, here's the part where we finally get to run some numbers. I know when I started, I said we're going to get into the numbers, but first we wanted to understand the concept behind how to run those numbers. Now we're going to get into what those numbers actually look like in practice, which I know for me is very, very helpful when I start to really understand these new requirements, new standards. It's when we see the numbers, when we see the journal entries, and that's what we'll walk through. So if you've got it handy, if you've got that trusty and crusty HB12C calculator, grab it now. If you've got an old 10 key, grab it now. A lot of us so likely will just rely on Excel, but now it's really time to run those numbers. We're going to go through these numbers fairly quick, but just a reminder that you do have access to these slides to take with you once the webinar is done. You will be able to utilize these and fall back on them as you continue to go forward in your GASB-87 implementation journey. So this is using that Canon copier lease that Eric provided as an example when right towards the end of his presentation component. So we're going to lease the 10 copiers for 60 months at a rate of $3,225 per month. That is also going to include setup, delivery, software, and what we'd call those get-going supplies, things like the first toner, some paper, etc. The timing of all of this, delivery, install, and acceptance, was December 29th, and then our fiscal year end is June 30. So really before the calendar turned, so really right before the middle of the fiscal year was obtained. December 29th is when that acceptance date is. And then the government has the capacity to pay, and that fiscal funding clause was waived. And we're going to get into this a little later. There are no potential components, so no components to consider. And like most agreements, like the thousands that we've reviewed, the discount rate was not spelled out in the agreement, but there's an assumption that we have determined that to be 3.5%. That discount rate, 3.5%. So those are the assumptions that we'll be using as we go through the numbers. One other, or I guess a couple other things. That lease payment, that monthly lease payment is due at the end of the month, and then we are not purchasing the copiers at the conclusion of the lease. I told you it's simple, just like a mortgage. I really am only saying that to just help us feel comfortable. We just keep repeating it. Hopefully we can gain more and more confidence. It's just like a mortgage. So here's really the time for Excel. We're using the effective interest method, just like a mortgage. We need those three items: principal, interest, and time. And remember, we are monthly, and then that formula is at the bottom of the slide. You don't got to write it down. You can take these slides with you, but maybe bookmark or make a note to yourself that formula is right at the bottom there. And then here's the result. What we're providing on this page is the first 6 payments, and then I've got 9 more pages of the rest. I'm kidding. We're not laying out the rest, but yes, there are 54 more rows of amortization. We didn't think we needed to repeat those for you, but you can tell where this is headed. Very, very simple. The payments, and then the breakout of principal and interest. And then based on the calculation, we know the value of that lease liability. And then that just is reduced at the end of every month when that payment is made. And then some annualized numbers so that you can see from an annual basis, not just a monthly basis, how does that look? And remember, it's spread over 60 months, but it was implemented at December 29th, so right in the middle of a fiscal year. So period number 1 is a partial year, and then as well as period number 6 is a partial year to capture all, or I guess the entirety of those lease payments. I'll just pause there. You can kind of take that all in, see some of the numbers. And then it's time to make the entry. So let's get into the debits and credits. Concepts are great, but as I said before, at least for myself, I'm a very visual learner. I'm sure there's a lot more of you out there just like me, once we start to see how those are in practice, right in the journal entries, it really, really helps us to fully grasp, or I should say, more fully grasp the concept and the implementation. So let's assume here that we have this capital lease in governmental funds. If you have had any capital leases previously, that first entry on this slide is going to look very familiar. Whenever you enter into that capital lease, you have to have that entry of a debit to capital outlay and a credit to other financing source for those lease proceeds. They offset each other. Net impact is 0 to the bottom line, but that's getting that required reporting within that governmental fund. Really the difference here is we've calculated out that lease liability at the present value. And so that is the amount that is included within the governmental funds for GASB 87. We then need to convert that to the government-wide financials using that amortization schedule to determine the current and long-term portion. And then we also need to convert that capital outlay into an intangible asset. So here's those entries. Like I said, as you walk away and you're able to either print out these slides or look at them on multiple screens, you'll really be able to see where all of these numbers are coming from. And I would say these are probably the more simple entries that you'll be making to get everything on the books. Then at the end of the year, so at the end of year one, which remember our example here is a June 30th government, you need to do some reclassifications based on those amortization schedules, and then also do some amortizations of those assets. So our government in this example has decided to amortize the asset side of the lease, at the same amount as the principal paid, which is acceptable and in some cases preferable to straight line. Remembering that we're discussed on amortizing the right to use asset. So we're only debiting the 2,983 instead of just a straight line amortization of that amount. The straight line amortization of that amount would be the present value calculation of that liability, or that right to use asset, 177,278. You divide that out by 60 months. We know in the first year it's a partial year, so it's only 6 months. So in a straight line amortization example, that would be roughly $17,728. But in this case, because we're not using the straight line method and we're using something different, it's only 2,983. So that's where it gets to be a little bit more complicated. You're going to want to make sure you understand the decision making on how you're going to amortize that, what method you're going to use. Usually that's going to fall back on some sort of written policy. Very, very important to take your time to understand that and to get that policy set up. Now that we've got our base numbers, what about the complications that may come and the further adjustments that may be in place? So I had mentioned it a few slides ago. You might have heard me say we're going to assume there's no components. And when I said components, it really was in anticipation of this. It can complicate things. I did see something in the Q&A about this too. And so hopefully we're able to address that question. So very, very common when there's space leases, things that are separable in each lease, usually surrounding common area charges, maintenance, utilities, security, parking. Anytime there's a lease with these types of charges or components, we need to separate those and then estimate their value. Many of them, and we'll call them CAM, many of them can be figured out by reviewing similar contracts that don't involve leases. But also, it's challenging that they can't. So don't take this one lightly. If you have a space lease and there's these common area charges, you have to consider these components. And it is going to be pretty common. And hopefully a lot of you are seeing this and going, yes, we've got leases with these components, and we are going to have to make sure that we separate them out. So really, if you have any of these 5 elements on the screen that would be in addition to the principal and interest, You're going to need to determine them, separate them out from other components, and then we've got to really apply the value. Some components also, to further complicate things, might have different terms. So for example, you might have one lease, got multiple components, but within that lease, you've got office space lease, but parking was outsourced to a separate company, and that separate company then supplies free parking for the first 6 years, that would be great. The first 6 months of the lease, which is awesome in itself. Okay, that's one component that is a little bit different than another component. What about utilities? Utilities are billed separately, including power and internet. These are all components that really need to be separated out and then assessed individually. So very, very complicated, and really a heads up to make sure you're reviewing these leases very carefully, in depth, and identifying those components. Really a 4-step process to identify those components. First is recognizing and identifying them, which could be the most challenging. Some of those lease agreements are lengthy. Some of them are lengthy and also in very small font. So really paying attention and making sure you recognize and identify those components. Here at Eide Bailey, we've actually implemented the use of artificial intelligence to attempt to work on identifying those. It's not always effective, so just be careful. Don't have a complete 100% reliance. If you are using AI, hopefully it is effective, but just a word of caution. Next, look for similar contracts if the contract is not identified in the lease. The example of a 1-year maintenance contract on a truck is just that. Thirdly, if the dealer charged for maintenance or if it was completely variable, there is a component of having professional judgment. It's okay, just be careful and be cautious on that professional judgment, but understand that is a part of it. You might get into a lease, you might identify some components, and it's just not a simple black and white resolution or conclusion. You're going to have to apply some professional judgment. Hopefully in those cases, you've got some individuals or a group internally within your government that you can rely upon, or also consider utilizing other outside resources like your auditors. We can't make those decisions for you, but we can help you answer some of those difficult questions. And then if it's just not practicable, it's just part of the lease. So you might ultimately land on that. Once they're identified, separate those payables for those charges and then record them unless it's just not practicable to do so. Really, the goal is to maximize the most observable information known. And again, a lot of those common area charges or CAMs. Lease combinations, those are a little bit different, and really they can be your best friend. Example, instead of leasing 10 multifunction copiers, if you are leasing 10 copiers at the same time, only one lease document is needed. That's great. The terms and conditions are all the same. They're all the same with the same counterparty. You've got a combination. Laptops would be another place where likely you have the opportunity, or you are in an arrangement where it is a combination. Try to group those things as much as possible. This is where we're encouraging this. If you can have a combination, it's going to be a lot easier. Look for them. They'll be within the same counterparty, same terms and conditions, multiple underlying assets that could be interchangeable. Caveat being, be careful. You could have components involved with combinations, so it can get tricky. You can have these combinations where you go, we can combine them together, but then within those combinations, there might be multiple components. So just always have that in mind as you're going through these assessments. Lease incentives. Probably used to be more common in previous years. You remember those car commercials where you get your, they'll make your first month's payment, they'll pay your closing costs, 0% leases in today's world, good luck finding those, but you probably remember those advertisements that came across the screen or came through an email. What is more common right now? Rent holidays, concessions made by the lessor, on behalf payments. Those are all incentives. So they're still out there, maybe just not as common as they used to be, but still out there. They need to be known because they will adjust the accounting for the asset and the liability. It's one of those moments where we've got to hold our thoughts, because breaking news, GASB 99, which is real recent, does clarify the language on those incentives. So really, it's a lease incentive is equivalent to a rebate or a discount, but it now also will include, thanks to GASB 99, the assumption of or an agreement to pay a lessee's pre-existing lease obligations to a third party, reimbursements of lessee costs, rent holidays, reductions of interest or principal. So really what that means is a third party may pay off an existing lease that you are in to get you out from that lease. If that situation occurs, that is considered an incentive. So that calculation would then need to be present valued based on when the incentive is received and the discount rate. If it is in the current period, then no present valuing needed. It's just an inflow to the lessee. So GASB 99, just a reminder, this can be implemented early, but that's what it would be, an early implementation if you were to do it alongside GASB 87. But really, this is not in effect until fiscal years beginning after June 15th, 2022. Just want to make sure I keep moving along so James has the opportunity to get into his slides. So modifications and terminations, it occurs when there's amendments that adjust that all important time factor, or in some cases, the interest factor. They can be terminations if the right to use the asset decreases. If assets are added, say new cruisers are added, the lease may need to be recalculated. If termination does occur, especially if early, it may result in a gain or a loss. So this really just all needs to be known as part of implementing the standard and awareness of those situations. This was a question that was brought up, and Eric responded to it, and it's about, can we establish a threshold? A very, very common question that we've had. Can we establish a threshold for recognizing the liability in a similar way as our capitalization thresholds? Well, first of all, at the end of every GASB statement, there's always a box that says the provisions of this statement need not be applied to immaterial items. So that's great, but what do we do with that? There always is at least that out there that, hey, if this is immaterial, it doesn't need to be applied. What does that mean? How do we identify what is immaterial? Do we do it individually? Do we need to look at it aggregately? It's very, very difficult. The implementation guide actually addresses this situation, and it really says, here's the words it says, it requires lease liabilities that are significant, and that's either individually or in the aggregate, should be recognized. Notice there's a big difference there. They said significant, they didn't say material. I know material is really an audit term, but I think it's very, very common for not only auditors to use it, but we also use that almost interchangeably when we're discussing things with clients, and probably when clients or governments are making decisions. Right, though, in the implementation guide, it says significant. So really it's saying even things that are less than material still need to be considered. So really, what I would say is be careful. Be careful. GASB pronouncements are not going to provide specific guidance when it comes to capitalization thresholds. Capitalization threshold itself is really just there's general best practices out there, but you're not going to find anything in GASB. Very common to establish thresholds to give you, kind of an out on ignoring certain immaterial or insignificant items, but really you have to be careful. So here's what we're going to say is, when in doubt, recognize the liability. The key here for us as auditors is this really needs to be looked at in aggregate. You could have a high volume of what you would consider immaterial potential lease liabilities. When you add them up, it's potentially material or significant. So I think really what we're saying is, when in doubt, recognize that liability. Okay, so we've talked about numbers, we've talked about recognition, we've talked about how to make those entries, we've talked about some of the nuances to consider. Now, preparing the note disclosure. First of all, remove all your old notes. Anything related to operating leases, there now is no such thing as an operating lease. Now there is one item, and it is a lease. And the key here is it's not a capital lease, it's simply a lease. This new standard effectively says there's one lease, and if you have that lease, it will be reported. There's no different types of leases anymore. It is now a lease. So just say leases. So what does it require? A general description, the basis, terms, conditions as to which variable payments, which are not included in the measurement of the lease liability, how were those determined? Existence, terms, and conditions of any residual value guarantees that were not included in the measurement of that lease agreement. Total amount of lease assets, related accumulated amortization, all disclosed separately from any other capital assets. And then the amount of lease assets by major classes of underlying assets disclosed separately from capital assets. So really making a concerted effort to have these all very much broken out, very transparent within your disclosures. It also requires a few different things, a few more things, I should say. The amount of outflows of resources for variable payments not previously included, the outflows of resources for other payments, such as residual value guarantees, termination penalties that were not previously included. And then something that's probably more what you're used to, principal and interest requirements to maturity. Those are in 5 subsequent fiscal years and then 5-year increments thereafter. So very similar to what you've been doing for other long-term debt, bonds payable, notes payable. And then commitments under leases, components of any losses associated with impairment. So the key here to understanding is, thankfully, it's not a whole lot different than today. It's just that maybe you haven't had to report capital leases previously. But the requirements today, or the requirements with GASB 87, are not significantly different than what they are with the capital leasing requirements that are in effect right now. So if you've had capital leases, hopefully it's not as significant as an adjustment, at least from the note disclosure standpoint. Okay, what other issues are out there that might impact leases? Subleasing. Subleases and subletting. It's been a part of accounting literature for decades. Really, what's the difference? A sublease is dealing with something that is already leased. A sublet is leasing only a portion of a leased asset to another party. So there are some differences. There's literally millions of these out there in the world today. If you think back to when you were in college, you probably, or you had a high likelihood of having some sort of situation where you were subleasing or subletting your student housing, your apartments that you lived in as you were attending college. Governments also are frequently involved in subleasing. So what GASB 87 does is it really emphasizes that there are at least 2 contracts. There's the initial contract between the original lessor and the original lessee, and then there's a second contract that involves that original lessee, who now in this second contract is the lessor, and then there is a sub-lessee. So keep in mind that the original contract must allow for subleasing. So be very, very careful there. You don't want to be violating any original terms or conditions of that original contract. I mean, think back to those college days when you were living in that apartment, and if somehow that was determined to be in violation of the original lease contract, boom, you're kicked out. Where are you going to go? So be very, very careful, and I would say be aware of that condition. Treat these as 2 contracts. So really, what has changed from old GAAP? Well, really, old GAAP prior to GASB 87, there really was no disclosure of subleasing. It happened, and then it was the wild, wild west of financial reporting. Again, it wasn't addressed in any standard, so some governments said we should probably disclose these sublease agreements. Others said it's not in standard, it's not required, I'm not going to. So it was all over the place. Likely, there was a lot of subleasing going on that was not disclosed. So GASB 87 really says we need to be consistent on that. Just looking through my notes, making sure I'm getting through this timely. Because I know James doesn't want to be cut off and have some adequate time here. Sales leasebacks, you might be considering this. This has probably been more of a consideration as remote working is becoming much more common. The hybrid work environment maybe it was temporary and now it's becoming more permanent. And really governments just don't need the space they used to have. So this might become more and more popular as governments go through their existing contracts and potential renewals and just a consideration of sale leaseback transactions. So a couple things here. First, there needs to be a sale. And for there to be a sale, all parties must have complied with provisions in the contract. Usually there's a transfer of deed. Also, the sale can't be cancelable. Money or an assumption of debt have been exchanged. Financing has been arranged. The parties doing the sale leasebacks are legally separate. And within governments, they're beyond the reporting entity, and then no continuing involvement with the selling government other than any potential future lease. The next step after we know there is a sale is to make the determination of if it is a lease. Really, you want to make sure there's two separate transactions at different times, especially in a situation where there's building rehab, where the lessee government may not have occupancy until a future period. And I apologize, I'm really trying to get through this quick so we can get to James. I would say the bottom line here, they're complex. I had probably 3 or 4 pages of notes to go through on this slide. They're complex. Please reach out to us, call or email us if you have questions. We'd love to work you through these complicated transactions. Leasebacks. So really quickly, this could happen where there's a leaseback. The parties are the same. They're leasing it back and forth together. Really, the transaction does not need to be disclosed because they're really going to cancel each other out. I'm sorry, it should be disclosed. There's likely a cancellation of the asset and the liability, but make sure it's disclosed. What if there's inter-entity leases? Really 3 different options here. Option number 1, a blended component unit and a primary government. It does not apply because everything's blended together. They're going to essentially offset each other. GASB 87 does not apply. However, if the blended component unit also has a standalone report or a standalone financial statement, then it would apply in that instance because there is no opportunity for that aggregation and elimination. So that's where the exception has happened. If the leases are between a discretely presented component unit and the primary government, so discretely presented, not blended, discretely, then GASB 87 does apply.
A lot of information to process. So to give you guys a chance to absorb it, we're going to take a step away from the discussion from those leases, from those traditional lease agreements, and then kind of go into a few more unusual arrangements. So given that it's near Memorial Day weekend, and there's a new fiscal year just right around the corner for the June 30th year ends, we also have to start thinking about GASB 94 and 96. So they're not applicable until next year, but you may want to still consider them because some of the decisions you make in relation to GASB 87 could potentially impact them. So we'll spend a few more minutes on those kind of agreements instead of these traditional leases. So first up to bat is a tongue twister. I always have a hard time saying this. It's GASB 94 public, private, and public-public partnerships, and availability payment arrangements. In the GASB, they call them PPPs. We've also been calling them P3s and APAs. So let's get into that statement. So cast your mind back to about 2010, 2009. The GASB definitely had some momentum in issuing statement after statement after statement to clarify the new types of transactions that had not yet been addressed in previous GASBs. So they were definitely on their race to GASB 100, which we should be seeing soon. But you know, they started it back then. They started that race back then. So during that time, they issued GASB Statement number 60. That's in relation to service concession arrangements, or SCAs. Why that's important is that GASB 94, the P3s, is going to modernize the accounting for the SCAs. Since back then we didn't have these fancy fandangled categories of deferred inflows of resources, deferred outflows of resources. So we didn't have those kind of categories, which, you know, these SCAs can more likely than not fit into. P3 standard also brings us SCA arrangements to be in line with accounting for leases. Now that we've got GASB 87 and a lot of the guidance from that, much of the SCA guidance, especially in determining what an SCA is, isn't going to change dramatically. What will change is how you value or how you measure some of the payable and receivables because they want to bring them in line with that lease accounting. So understanding the jargon is like basically any other GASB standard. So once the definitions are known, the accounting and then financial reporting seemingly falls into place. Looking at the definitions for those who haven't fallen asleep yet, because that stuff was so riveting, they may look familiar from the outset. So I'm not going to read those. Just keep them in your mind's eye if you've got one of these arrangements. One thing to consider, though, is the newest definition that was put into place, which is the availability payment arrangements. So these arrangements are in which the transfer pays an operator for activities. So the transfer being the government is paying the operator, typically a corporation, for activities that can include design, construction, financing, or operating non-financial assets in lieu of an operator collecting from third parties and keeping that money. So these are based on the availability of the asset to provide the services instead of the amount of services provided. It's probably easier to think about P3s in examples. So talking about APAs, those are payments based on milestones. It's primarily for design, build, operation systems. So in this first example, a corporation collects all the fares for a period in a transit system, and then they remit it to the government. But the government is paying the corporation fixed payments based on certain milestones. So for example, if it's a transit system, maybe total miles driven. So you can see that, you know, total miles driven wouldn't necessarily be, would be a more fair concession for the corporation to maintain certain routes instead of determining what routes are most profitable to that corporation. P3s, which could be public or private operations, are when governments outsource things like tolls. Here in California, a lot of the toll roads are often P3s. Finally, you've got service concession arrangements, which are commonly what I've typically seen are municipal golf courses and utilities. So these have been recognized, as I said, since Statement 60, and they're bringing them in line with GASB 87. So just to remember what an SCA really is, it's basically a P3. So they actually use that terminology, the public-private partnerships, where an operator collects and is compensated from fees from third parties. So and then the government transfer determines and can modify or approve services provided, who the services are provided to, and finally, the government has a significant residual interest in the underlying asset at the end of the arrangement. So that's important so you can evaluate the assets associated with these arrangements in the context of GASB 60, as it's one of the decision points in applying either GASB 94 or GASB 87. So you may want to refresh your understanding of a statement when you come across these types of partnerships. So due to differences in contracts, there's a slightly different gap that emerges in the form of an if-then decision tree. This includes decision points such as if the arrangement is an SCA, or if there's a new asset or existing asset. For example, if there's no SCA and the agreement lines up with lease accounting for an existing and unimproved asset, then by all means, apply GASB 87. If a new or improved asset results in the agreement and is not an SCA, then you're going to apply GASB 94 with some special considerations in relation to the asset. So let's go ahead and go through that GASB decision, the GASB's decision tree, something that they've actually published to help us go through make those decisions. So the variability of definitions and contracts may result in different outcomes, and it's easiest to see it through this decision tree. So first, you're going to look to see if the government has a P3. If there's a P3 that meets the definition of a lease but is not an SCA, and the underlying assets are existing assets, and there are no improvements that need to be made, or any improvements that are made have to be taken away before the expiration of the P3, then you're going to follow GASB 87. If it's an SCA, then you're just going to follow a service concession arrangement. You're just going to follow GASB 94. If you make improvements that you're going to take custody of, then you would follow GASB 94. And if you're building or constructing assets or purchasing assets, then it would follow GASB 94. So once we break it down, I think once we break it down like that, if you've got this decision tree, it's kind of in one of your cue cards, I think it's a little bit easier to deal with. So that's just kind of a broad overview of GASB 94, stuff that you have to consider as you're implementing these lease accountings. The implementation period is going to begin on July 1st of this year, so for fiscal year 2023. This is also going to require, this could potentially also require beginning balance restatement. So try not to commingle this too much with the GASB 87's implementation. You're going to use the facts and circumstances as of the period of implementation, just like GASB 87. And make sure that you're analyzing those service concession arrangements. The next one are SBITAs, subscription-based information technology arrangements. And so you may be asking yourself, what are those? So with the pandemic, we've seen a lot more of a push in the direction of utilizing these kind of arrangements. So if you don't think you may have one now, I still encourage you to pay attention, because you're probably going to have one in the near future, or there may be something that you hadn't considered as a SBITA that really does qualify. So SBITAs are more prevalent in practice than P3s, and even for some governments, regular leases. So you're probably using one right now, such as Office 365, Zoom, Windows, NetSuite, Salesforce, and there's a whole slew of others. So those softwares that I just mentioned are considered software as a service, or SaaS. So in addition to software as a service, you need to consider other kind of services such as platform as a service, or PaaS, which includes like Windows Azure, Apple iOS, Google, IBM, Oracle, Cisco, and Citrix all offer infrastructure as a service. And then Amazon, AWS, and Snowflake both are considered data warehouse as a service. So differentiating those are a little bit tricky, but simply put, a software as a service is software that's available from a third party over the internet. So you're logging into a website, to utilize that software. Hardware PaaS, platform as a service. There's hardware and software tools available over the internet. Infrastructure as a service, cloud-based services, pay-as-you-go services such as storage, networking, virtualization, those kind of services that are helping you develop your infrastructure. And then data warehousing as a service, they're providing data storage, warehouse management services without investing any proprietary, excuse me, all the P's from the P3s are messing me up, without investing in a proprietary data warehouse solution. So these are all colloquial known as cloud computing. And GAAP needed to evolve in this area because of the many trends, most notably as proven by this, the past 2 years during the pandemic. These tools are essential now, and they've become so very quick, and they've become very, very quickly. GAAP has addressed software in GASB Statement 51 for intangibles, but that statement generally focused on internally generated software as an intangible, and along with the applicable stages that wouldn't necessarily apply. So second, the cost, data integrity, and management risk of providing these services on premises is skyrocketing. So it becomes a lot more cost beneficial to have these kind of arrangements, the SBITA arrangements. Next, the speed of evolution of these tools, including artificial intelligence, RPA, or robotic process automation, and bots continuously update to defend against intrusion. So that speed is just increasing. So most, if not all, governments can't keep up. So finally, the structure of the contracts is like P3s, which we just heard about, but they're a lot less flexible. They're subject to different laws in different regions. For example, in Europe, there's the General Data Protection Regulation, or here in California, the California Consumer Privacy Act, which goes beyond those standards. So you may want to catch up on those standards as you start evaluating these. Here are some of the SBITAs that are in use. Just kind of a quick snapshot. I mentioned Android, Mimecast, Oracle, Windows Azure. So keep an eye out for these softwares in case your agency utilizes these softwares. GASB 96 contains some hopefully familiar language to you as of now. After all, it's appeared many times during our workshops. So subscription-based information technology arrangement, or SBITA, is basically a contract that's conveying a right to use. So there's that right to use asset again. Hardware, software, or combination of both, including infrastructure, for a period of time, for a fixed period of time in an exchange or exchange-like transaction. So this is just about verbatim in GASB 87. So it shouldn't be anything new to you. One thing to consider though is when do we apply GASB 96 and when do we apply GASB 51? So SBITA has a defined time period or end date. Additionally, GASB 51 primarily addresses internally generated software as well as perpetual. So if you plan on paying for this technology indefinitely, or you internally develop the software, then you're going to apply the provisions of GASB 51. So there are 3 stages. There's the preliminary project stage, which includes the basically RFP evaluation, seeing what's out there and making that decision point. All those, that stage right there is going to be totally expensed. They're all period costs. They don't go into the creation or putting the asset into use. Then we have the application development stage. So this includes design of the chosen path, software configuration, coding, installation of the hardware, parallel processing. This includes the design of a chart of accounts, setting up workflows, access permissions, activities that, had they not occurred at this point in the process, the software would not be able to be placed into service. Training is not included in this process or in this stage. So post-implementation and operation stage, that includes training as well as software maintenance, and that again is all expensed. So one of the more controversial aspects of GASB 96, which was the same in GASB 51, was a lot of people believe that training needed to be capitalized because you needed the training in order to utilize the software. When in reality, if you're somebody like me, I like to go into a software before I get any training and I push all the buttons to see what works and how things get recorded. So training isn't necessarily a required element to get the software into its intended use or placed into service. So it's therefore considered an expense. So in GASB 96 is nearly identical to GASB 87. However, there's no provision in GASB 96 where the government is a software vendor. So unlike leases, there's no symmetrical component such as lessor accounting for a government as a vendor. The other difference is that there's no residual value or purchase options to consider when calculating the value. So when you join us on June 22nd for the lessor accounting, you're not going to have to listen to the provisions related to GASB 96 because they just don't exist for lessor accounting. The accounting of financial reporting are exactly like lessee accounting and reporting, the same debits, the same credits, principal, discount rate, etc. The related training costs for a SBITA should be a component. Otherwise, intangible assets going to be different than the initial liability. GASB 96 also replicates short-term guidance of GASB 87, but the likelihood of it being a short-term agreement is going to be fairly remote because once you're into an environment, then it's very difficult to get out. For example, for those of you who have iPhones, or if you used to have an Android and moving over to an iPhone or vice versa, moving from one environment to the other is not necessarily the easiest thing to do. It takes a lot of work. Now imagine applying that to your governmental agency. So you more likely than not that these are going to be long-term in nature unless you're doing like a test run of them. Implementation is going to be the same as GASB 94. It's going to be next year, fiscal year 23, and you're going to use the, and again, just like 94 and 87, you're going to use the facts and circumstances at the transition date, and it's going to require beginning balance adjustment. So the GASB, they're fairly forward-thinking in making sure that the framework for all three standards align as much as possible. They all have scope, not in scope provisions, common definitions, term calcs, liability and asset calculations, which are similar using a term calculation. So a lot of these are pretty much the same across all three of them, all different types of transactions. So the main difference is in a P3, you may have an additional asset that you have to capitalize. So GASB 99, again, just came out. Some of it's effective immediately. So this is where it applies. For GASB 94, 96, it considers the options to terminate or purchase. But it's not fully applicable to, say, incentives, because there are not necessarily incentives in GASB 94 and 96. So when you're implementing 94 and 96, make sure you consider GASB 99 because that's super important to get included. All right, so for a lot of you, we're your auditors. So we need to put our auditor hats on and then speculate what that means for you. The reason I say speculate is the audit and accounting guide associated with GASB 87 is not out yet. Hopefully it's going to be out soon, but it's just some things that we have to consider, things that we're already brainstorming of items that we have to perform in order to get an understanding of your liability and the assets and whatnot. So when we think about GASB 87 in the various audit assertions, completeness is going to be key. Governments are going to need to evaluate all contracts to determine whether they contain a lease. You need to create an inventory of all leases. And that's pretty much going to be your first step. You need to develop strong internal controls over contracting. You need to ensure that all leases are identified by the accounting department and that the procurement process is evaluated and updated to ensure that you capture all of those. So governments routinely sign contracts that may or may not align to a definition of a lease. These contracts don't use the word rent or lease. They are not identified under the old lease accounting guidance. Given the limited impact of the failure to identify a lease under pre-GASB 87, governments may not identify these embedded leases. So, however, identifying these leases becomes a lot more important with the implementation of GASB 87. And we'll talk a little bit more of those. I know we're running a little bit short on time, but we'll just touch on those in just a minute. Recognition and measurement is important to your policies and procedures. So are they effective and utilized for your recorded contracts? And then there's presentation and disclosure. But as you saw, not much has changed too much. Compliance related parties are also going to need to be considered. Focus on all this to get ready for this year. Make sure your policies and procedures are updated to address P3s and SBITAs. Software solutions, there are quite a number about them. So you need to ask yourself a couple questions. What have you done for your capital leases in the past? And do you have the source information? We're finding that there's a breaking point of whether you can use Excel or some other spreadsheet versus software is about 25 leases. So anything above that's going to be really difficult to maintain. Plus, Excel doesn't necessarily have internal controls. Things can be easily changed. So if you've got more than 25 leases, definitely consider going start researching a couple vendors that can provide you lease or options. Let's see here. All right, so I did say I wanted to touch on embedded leases because these are super important. So they're not explicitly mentioned in GASB 87, but they can be present in different types of contracts that are included within GASB 87. So some areas where they may commonly identified include as a service contract, a sales contract, advertising contracts, transportation or construction arrangements, related party contracts. Finding these contracts, you could start by querying your records for recurring payments for the same counterparties at similar frequencies. So you'll be surprised about what is actually in those records. So I personally advise a lot of my clients to utilize 2 or 3 years worth of disbursement data and scrutinize those payments that are once a year, twice a year, quarterly, monthly, just to determine if it could be based on a lease agreement. The other thing you could do is review descriptions in your payables for keywords such as lease. That would be kind of an indicator. Agreement, periodic or monthly. You want to pull those off to the side and see if they're maybe based on a lease agreement. Other places that we have found embedded leases include public colleges and universities, public healthcare, airports. They all have potentially embedded leases. So, there's cafeteria equipment in the public colleges. There's in airports, there's terminal space like concessionaire agreements. But keep in mind that there's also regulatory lease accounting that you want to consider when performing all that. Implementation strategies. I'll try to wrap this up here in the next couple minutes. Form a team. Think of who needs to be involved. It could be a team of one, but you need to have that team of legal, consider your legal department, your purchasing department, internal audit, and then of course somebody in accounting because us accounting folks like to control everything. Implement, remember it's retroactive. Use the facts and circumstances at the date of transition or at the beginning of the period of implementation. If you've got comparative financial statements, you actually need to go back to July 1st, 2020. So just make sure that you consider that. And then, of course, never stop implementing. We do have an example in here where the government already has a capital lease for $20,900. Outstanding principal, the asset is $20,900. The outstanding principal is $21,500. And then based on the updated guidance, the liability was adjusted to $22,500. So in this case, the government's going to report a $1,000 increase to the lease liability to $22,500. And they're going to increase the asset by $1,600 to, again, $22,500. That difference of $600 is going to be your restatement in your statement of net position. So that's just a very quick example to implement for the prior period adjustment. And that is just a reminder, don't stop implementing. Every lease has to be implemented. You're basically re-implementing GASB 87. Every lease should be evaluated separately. That you just don't want to stop. You can't stop implementing now that this is going live. And we'll open it up to any final questions.
It looks like only 2 questions left in the chat or in the Q&A.
Yeah, Amy, I've been typing questions as we go along just to make sure we do that. I want to first thank Brian and James. And there's a ton of content out here, and I thank you all for keeping with us. going over data entry under GASB 87, 94, and 96. Please reach out to me directly on that. I'm more than happy to talk to you on it. LinkedIn online learning courses, could it be a SBITA? I don't take LinkedIn online learning. I don't know if you have to subscribe to it for a definite time, but it might be only a period to period subscription. So I'm just not sure on that one. Again, feel free to reach out to us directly on that. Is anyone aware of a government that implemented 87 early and already issued financial statements? The only ones I know of are very, very small. I don't know if that would apply to your current situation. And certainly every government is different. And if you want to reach out to us in terms of what presentation and disclosure would look like, we're more than happy to help you on that one. With that, Amy, I guess I should turn this back to you. And certainly I'm glad everybody made it through today. And hey, it was better than watching the value of Target stock meltdown, which by the way, right now it's down about 29%, no, 28% in one day, Target stock. I better go shopping there quick. In any case, Amy, back to you. Thank you, gentlemen.
All right, guys. Well, thank you all so much for attending. Thank you, James. Thank you, Brian. And thank you, Eric. Hope you guys have a great rest of your day. We'll talk to you guys next time.